Jamie Dimon runs JPMorgan Chase, the largest bank in America. The bank that manages over $3 trillion in assets. The bank whose CEO has spent 30 years building one of the most sophisticated risk assessment operations in the history of finance. This week, in an interview released Monday evening, he said something that should have stopped every investor, every financial planner, every pension manager in the world mid-sentence. He said he wouldn't buy US stocks at current prices. He said he wouldn't buy long-dated US Treasury bonds at current prices. He said he wouldn't buy long-dated US Treasury bonds at current prices. He said markets are systematically underestimating the risks, the wars, the geopolitical tensions, the military spending, the government deficits that are building in the global economy right now. Financial media covered this as a notable comment from a prominent executive, a data point, one perspective among many. History has a different framework for this kind of statement, because when the person managing more money than most sovereign nations publicly declares that the assets at the center of the global financial system are mispriced on the downside, when the biggest banker in the world says he wouldn't buy America, history pays very specific attention, because history has seen this before. Before examining the historical parallels, it's worth establishing precisely what makes Dimon's statement significant, as distinct from the constant stream of market commentary, economic predictions, and bearish takes that flow through financial media continuously. Jamie Dimon has been CEO of JPMorgan Chase since 2005. In that time, he has navigated the bank through the 2008 financial crisis, during which JP Morgan was one of the few major American banks that did not require a government bailout, the European sovereign debt crisis, the 2020 COVID economic collapse, and the 2022 to 2023 rate tightening cycle. He has consistently been regarded, including by people who disagree with him on policy, as one of the most analytically rigorous executives in American finance. Dimon is not a perma bear. He is not a commentator whose business model depends on predicting crises. He is a banker whose entire institutional interest lies in healthy functioning financial markets, because JP Morgan profits when credit flows, when deals get done, when asset prices support borrowing and lending. A JP Morgan CEO who says markets are overpriced is not telling you something that benefits his business. He is telling you something that his risk assessment has compelled him to say, despite the institutional incentives that would normally push in the opposite direction. This is the first dimension of the signal's significance. It comes from someone with both the analytical capability and the institutional incentives to understate rather than overstate risk, who is nonetheless overstating it publicly. The second dimension is specificity. Dimon did not say markets feel uncertain, or that there are headwinds, or that investors should be cautious, the hedged language that executives typically use to convey concern without making a falsifiable claim. He said he wouldn't buy either of the two central assets of the American financial system, equities and long-dated treasuries, at their current prices. This is a specific falsifiable statement that carries professional and reputational risk. Executives make this kind of statement when their conviction is high enough to override the institutional incentives to avoid ambiguity. The third dimension is a specific list of risks he cited: wars, geopolitical tensions, US-China conflict, rising military spending in a time of mounting government deficits. This is not a list of cyclical economic risks, the kind of concerns that generate a normal bear market and then resolve as the cycle turns. This is a list of structural, geopolitical, and fiscal risks, the exact risks this series has been documenting across 18 videos. Dimon is not warning about a recession. The historical record of major financial institution leaders expressing loss of confidence before major market dislocations is both more extensive and more specific than most people realize. The 1959 crash and the Great Depression that followed are the most thoroughly studied financial catastrophe in modern history, and one of the most striking findings of that historical study is how many senior financial figures expressed significant reservations about the market's trajectory in the years and months preceding October 1929, and how comprehensively those warnings were ignored or minimized. Paul Warburg, one of the principal architects of the Federal Reserve System and a senior partner at Kuhn, Loeb and Company, one of the most prestigious investment banks of the era, published a remarkable warning in March 2019. He wrote that the orgy of unrestrained speculation in the stock market would lead to a general depression affecting the entire country and urged a contraction of the credit that was fueling the speculative bubble. Warburg was not an anonymous commentator. He was one of the most respected figures in American finance. His warning was public, specific, and falsifiable. The market's response was to continue rising for another 7 months, and commentators dismissed Warburg as too conservative, too old-fashioned, too unable to understand the new era of American prosperity. Roger Babson, an economist and statistician, gave his famous Babson Breaks speech in September 1929, weeks before the crash, in which he predicted that sooner or later a crash is coming, and it may be terrific. Markets fell 2% on the day of the speech, then recovered, and most commentators dismissed Babson as a chronic pessimist who had been making similar predictions for years. Bernard Baruch, one of the most successful investors of the era, had been quietly selling equities throughout 1928 and early 1929, converting his holdings to cash and bonds. He did not make public statements about his reasoning, but his actions spoke clearly. When asked later why he had sold, he said he knew the market had reached unsustainable levels when he received stock tips from his shoeshine boy, the democratization of equity speculation to the point where everyone was buying had historically marked the peak of every bubble he had observed. The pattern across these 1929 era warnings is consistent and instructive. The people closest to the market, the bankers, the sophisticated investors, the people whose professional lives were spent assessing financial risk, recognized the structural fragility before the general market did. Their warnings were specific and falsifiable, and they were comprehensively ignored or minimized until the event they had warned about arrived. The 2000 financial crisis produced an even more extensively documented record of early institutional warnings, in part because the post-crisis investigations, regulatory reviews, and academic studies created a rich historical record of who said what and when. The warnings came from multiple directions, from figures with different institutional positions and different analytical frameworks, and they converged on the same underlying concern. The American housing market had developed characteristics of a systemic bubble. The financial instruments built on top of it were more fragile and more interconnected than markets were pricing, and the unwinding of those positions would be significantly more severe than consensus projections suggested. Nouriel Roubini, the NYU economist who became known as Dr. Doom for his 2006 IMF presentation predicting a collapse of the housing market and a broad financial crisis, was widely dismissed as an attention-seeking extremist at the time of his warning. His specific predictions, falling home prices, bank insolvencies, deep recession, were outside the range of any mainstream forecast when he made them. Bill Gross, then managing the world's largest bond fund at PIMCO, began reducing exposure to mortgage-backed securities in 2006 and publicly raised concerns about the credit quality of housing-related instruments. John Paulson, the hedge fund manager who eventually made billions betting against the housing market, spent 2006 and early 2007 building his short positions while being told by multiple Wall Street banks that his analysis was wrong. Inside the major institutions, the warnings were even earlier and more specific. In 2005, Raghuram Rajan, then chief economist of the IMF, later governor of the Reserve Bank of India, presented a paper at the Federal Reserve's annual Jackson Hole conference arguing that financial innovation had made the global financial system more fragile, not more resilient, and that the incentive structures in the financial industry were creating risks that would be catastrophic if they materialized. The response from the audience, which included Alan Greenspan and other senior financial figures, was largely dismissive. The common thread across these 2006 to 2007 warnings is the same thread visible in the 1929 precedents. The people with the deepest analytical access to the financial system recognized the structural fragility before the general market did. Their warnings were specific and publicly stated, and they were minimized until the event itself arrived. The historical pattern of institutional warnings being ignored before major financial dislocations is not random. It reflects specific and consistent mechanisms that operate in every cycle, mechanisms that are worth understanding because they explain both why Dimon's warning is significant and why markets may not respond to it proportionally. The first mechanism is the career risk asymmetry. For most market participants, portfolio managers, analysts, financial advisors, the professional consequences of being wrong in the consensus direction are far less severe than the consequences of being wrong in the contrarian direction. A portfolio manager who stays long equities and the market falls has company. Every other manager who stayed long falls with them, and the underperformance is attributed to market conditions rather than individual judgment. A portfolio manager who goes defensive on the basis of a structural warning like Dimon's and the market continues rising faces a different consequence. Underperformance that looks like individual error rather than shared misfortune. This asymmetry creates systematic pressure to stay with the consensus even when the analytical case for diverging from it is strong. The second mechanism is the time horizon mismatch. Structural warnings of the kind Dimon is making, warnings about geopolitical risk, fiscal unsustainability, and misaligned risk pricing, operate on timelines of months to years. Financial markets operate on timelines of days to quarters. A warning that a structural repricing is likely sometime in the next 1 to 3 years is not actionable for a portfolio manager whose performance is measured quarterly. The warning may be analytically correct and practically irrelevant to the immediate investment decision, creating systematic underprioritization of structural risks relative to cyclical ones. The third mechanism is narrative momentum. In July 2026, the dominant market narrative is that the US economy is proving resilient to the Iran war's pressures. The CPI data came in below expectations. Semiconductor exports are strong. The S&P 500 has recovered from its 3-day losing streak. Dimon's warning cuts across this narrative. In every previous episode of Ignored Institutional Warnings, the warning came at a moment when the dominant narrative was positive, when the market's near-term data was supporting the case for continued optimism. The structural warning requires participants to discount the near-term positive data in favor of the medium-term structural concern. This is analytically demanding and institutionally unrewarded. The fourth mechanism is the source credibility discount. Dimon has been making broadly cautious public statements for several years, warning about geopolitical risk, fiscal unsustainability, and market fragility in various forms. Markets that have heard similar concerns from the same source over. Reading Dimon's statement through the lens of institutional communication, understanding what a JPMorgan CEO can and cannot say publicly, and what the specific language he chose reveals, produces a reading significantly more alarming than the headline version. Dimon said he wouldn't buy US stocks or long-dated treasuries. This is a public statement, but the institutional subtext is more specific. JPMorgan Chase, as of its most recent reporting, holds substantial positions in both US equities and US Treasury securities as part of its normal banking operations. When Dimon says he personally wouldn't buy these assets at current prices, he is drawing a careful distinction between what the bank holds as a matter of business necessity and what his personal risk assessment suggests about their current valuation. This is not a statement that JPMorgan is selling its treasury holdings or reducing its equity exposure. Regulatory and operational constraints prevent that kind of rapid repositioning. It is a statement about the direction of his risk assessment. The specific risks he cited, wars, US-China tensions, military spending, government deficits, form a precise overlap with the structural themes this series has documented. The wars reference covers the Hormuz conflict and its energy price consequences documented in multiple videos. The US-China tensions reference covers the Treasury sales documented in the 12th video. The military spending in a time of deficits reference covers the NATO burden shifting and fiscal dynamics documented in the 13th video. The government deficits reference covers the debt cycle dynamics documented throughout the series. Dimon is not making a vague macro concern statement. He is identifying the same specific structural risks this channel has been analyzing from the perspective of the institution that arguably has the most sophisticated real-time visibility into how those risks are flowing through the financial system. The most consequential element of his statement is the specific combination, neither equities nor long-dated treasuries. This combination rules out the standard diversification response. The idea that if you are worried about equities, you buy bonds, and if you are worried about bonds, you buy equities. Dimon is saying both central assets of the conventional portfolio are mispriced simultaneously. This is structurally identical to the environment documented in the 8th video of this series, the stagflation and structural inflation environments, in which the conventional diversification between stocks and bonds breaks down because both assets are vulnerable to the same underlying structural conditions. The S&P 500's recovery from its 3-day losing streak, up in nil point 9% on Tuesday, driven by semiconductor stocks, is itself a data point worth examining in the context of Dimon's warning and the historical pattern of ignored institutional signals. The immediate market narrative explaining the recovery is specific: Korean chip exports almost tripling in early July, Taiwanese export orders beating forecasts. The AI-driven technology demand that has been the primary positive narrative for equity markets in 2025 and 2026 continues to generate strong fundamental data points that support the bull case for technology stocks specifically and equity markets broadly. This is exactly the structure of every major pre-dislocation recovery in the historical record. In the months before October 19, 2019, the market recovered from multiple small corrections on the basis of strong corporate earnings and the continued story of American industrial prosperity. In 2006 and early 2007, markets repeatedly recovered from housing-related stress on the basis of strong corporate earnings in non-housing sectors and the continued global growth story. The characteristic pattern is that the structural warning and the near-term positive data coexist for an extended period, months, sometimes longer, during which the market interprets each recovery as evidence that the structural concerns are overblown. The people who sold on the structural warning too early underperformed during this period, reinforcing the institutional incentives toward dismissing the warning. And then, when the structural condition expresses itself in a form that the near-term positive data can no longer offset, the repricing is rapid and severe. The oil at $91 is the data point that most directly threatens the current recovery narrative. Semiconductor demand is strong, but oil at $91 is feeding into inflation dynamics that constrain the Federal Reserve's ability to support the market with rate cuts, raising input costs for the manufacturing sector that produces the chips the AI boom demands, and adding a supply-side inflationary pressure that the CPI data the market rallied on will not continue to show as benign once oil at $91 has had time to transmit through the full economy. The historical record on the timing relationship between major institutional confidence signals and subsequent market dislocations is specific enough to be useful, if appropriately bounded by the significant uncertainty that always accompanies pattern-based analysis. In the 189 cycle, Warburg's warning in March 1990 preceded the crash by approximately 7 months. Babson's warning in September 1990 preceded the crash by approximately 6 weeks. The range between the earliest clear institutional warning and the market peak was roughly 7 months. In the 2007 to 2005 cycle, the earliest clear institutional warnings, Rajan's 2005 Jackson Hole paper, the first significant public statements from Rubini and Gross, preceded the peak of the housing market by approximately 1 to 2 years and preceded the S&P 500 peak of October 2007 by approximately 2 years. The range between the earliest institutional warnings and the market peak was substantially longer than in the 1990 cycle. This range from weeks to years is too wide to be directly actionable as a timing signal. The historical record does not tell you that a Dimon-level institutional warning predicts a crash in 6 months or 18 months or 36 months. It tells you that such warnings, when they have been issued by figures with the analytical access and institutional position comparable to Dimon's current position, have historically preceded dislocations rather than followed them. The more actionable lesson from the historical timing data is not about when the dislocation occurs, but about the period between the warning and the event. In both 1929 and 2007, the period between major institutional warnings and the eventual market event was characterized by continued market gains, sometimes substantial gains interspersed with warning level corrections that recovered. The investors who acted on the structural warning at the cost of near-term underperformance were not wrong in their analysis, they were early. And early in structural transition investing is consistently less costly than late. Placing Dimon's warning within the framework this series has built across 18 videos produces a specific and significant analytical conclusion. This series has documented 18 mechanisms of the current structural transition: bond market stress, gold accumulation, petrodollar vulnerability, middle-class wealth destruction, dollar sanctions, weapon, internal political fragmentation, reserve currency timeline, asset class survival record, ceasefire fragility, Fed chair transitions, Chinese Treasury sales, alliance burden shifting, convergence day dynamics, stagflation pattern reassembly, institutional bypass through stablecoins, IMF structural inflation admission, and now institutional confidence withdrawal by the largest banker in America. Each of these mechanisms has been documented independently, drawing on historical precedents that span 3 to 5 centuries of monetary and geopolitical history. Each mechanism, viewed in isolation, represents a significant structural concern. Together, they represent the most comprehensive set of structural warnings this channel has assembled in any comparable period. Dimon's statement this week does not add a new mechanism to this list. It adds something potentially more significant: institutional confirmation. The CEO of the largest bank in America, with access to real-time data flows across the entire financial system, is looking at the same structural conditions this series has documented from the inside of the institution most capable of assessing them and reaching the same conclusion. He is not predicting a crash, he is not timing a dislocation. He is saying what every analytical framework applied to the current structural conditions suggests: that the assets at the center of the conventional portfolio, U.S. equities and long-dated U.S. treasuries, are not adequately pricing the structural risks that are visible to anyone looking at the same data he is looking at. The historical precedents for this kind of institutional statement, issued at moments of genuine structural stress by figures with genuine analytical access against the prevailing market narrative, do not tell us when the structural conditions will express themselves in prices. They tell us that such statements have historically marked the transition from the gradual, denial-compatible phase of a structural stress period to the phase in which the repricing becomes inevitable rather than merely possible. Jamie Dimon manages more money than most countries have in their treasuries. He has spent 30 years building one of the most sophisticated risk assessment systems in the history of finance. And this week he said he wouldn't buy the two central assets of the American financial system at their current prices. History does not treat this kind of statement as a data point. History treats it as a marker, a moment that gets recorded alongside Warburg's March 1929 warning, alongside Rajan's 2005 Jackson Hole paper, alongside the handful of other moments when the people with the deepest access to the financial system's internal workings said publicly what they were seeing. The markets continued rising after Warburg's warning. They continued rising after Rajan's warning. The structural transition documented in this series has been continuing through every recovery, every deal euphoria, every softer than expected data point that provided a reason to conclude the structural concerns were overblown. Dimon's warning does not change that trajectory, it confirms it. From the inside of the institution best positioned to see it clearly, subscribe, because this series tracks the confirmation as it arrives. And history says the confirmations are always clearer in advance than the markets that ignore them.